Hi, everyone. I am Celeste Barr with eXp Realty, and I'm here with Steve Smither with Cardinal Financial.
Obviously, we do refinances as well as purchases, but I always say purchases are where my heart lies because I'm a very relational person. I like to solve issues and whatnot, and to be able to be there for my clients, to be able to answer their questions, and to be able to even kind of be like a teacher with them through the process and help them in understanding the process. And like, we won't know what to do if we don't talk to you every day. So that's a big part for me, and I enjoy that.
What are some of the biggest misconceptions buyers have about getting a mortgage today?
I think the number one thing is people look at the mortgage industry and getting a mortgage the way they think they would do it. And unfortunately, the mortgage world doesn't look at things the way you and I would look at things. So, for instance, let's say somebody gets a job, they're making really great money. They've been doing it for, let's say, 9 months, but they changed industry. So like for myself, I was a teacher. I always used to joke that once I became a loan officer, I couldn't get a loan for myself because I changed industry. And so even if you're making good money, we have to have a 2-year history of that. So somebody on the outside would be like, well, I don't understand. I've been working. Why can't you just use my income? A lot of people will change jobs. And unfortunately, that's something that can mess things up, especially if they don't work a regular 40-hour job and they work different shifts, and sometimes the hours change. And so I think that's one of the biggest things that kind of come into us. And then I would say one last thing would also be credit, because a lot of people also look at either their credit card or maybe Credit Karma tells them what their credit score is. And then they come to me and we run credit and the credit score is different. They're like, no, I've got like a 750 credit score. And then I run it, it's like 712. And then all of a sudden there's some adjustments and maybe the rate's not the best because they don't have the perfect credit score, but they thought they did because what Credit Karma said. So those are the things that get kind of confused because people just don't know. And then, of course, they hear stories. My dad, bought a house 4 years ago, and he told me how it works. And it's like, yeah, unfortunately, our business keeps changing, as you know. And so it's not as simple as what it was 5 years ago or 10 years ago or whatever the case is. So I would say that's probably the number one. A lot of things that people don't even think about, opening up new accounts and transferring money. The number one thing I think that takes the most time and attention for my clients these days is transfers in their bank accounts. As you and I were a little older, we can go back to the day where we basically would have a checking and a savings, and that was it. And every time that money goes to a different account, we have to show not only the account where it's coming out of, but the account where it's going into. And so that's something that really becomes monotonous. And so anytime I get to talk to people ahead of time, I say the number one thing I would do is try not to move the money. Try to use it all in one spot if possible, which I know is to a point is kind of hard, but at least those first couple months right before buying a house, that's really important. Another huge thing that happens way too often is people wind up buying things before they buy a house. I keep talking about the story where I was literally selling my place in Mount Prospect, buying a home in Lake in the Hills, and 3 days before the sale, the guy that was buying my condo bought a car. So now all of a sudden, he no longer qualifies for my condo. And here I am 3 days later, I'm supposed to be buying a house. And now I'm scrambling, trying to find a way to be able to close because the person that was buying my condo can't buy it anymore. But luckily, they were able to find, I don't know if it was a cosign or whatever, but they were able to close, but it took 2 weeks to happen. He could have lost that deal because he bought a car.
I would ask another question about this because I realize, these are really good points that you're making. But I'm wondering if one of the other financial mistakes people make is that they wait too long to get pre-approved.
I'm a part of many forums online like everybody else. And one of the things they asked was like, how soon should we get pre-approved? And I said, now. And they said, well, I'm not buying for like another year. And I was like, exactly.
What does FHA mean? What does that mean?
So there's basically two different versions of mortgages in the normal realm, or what they call qualified mortgages. There is conventional, and then there's what they call government. Conventional is the basic Fannie Freddie, okay, which means we all work by the same standards, okay? You could do 3% down as a first-time home buyer, 5% down if you're not a first-time home buyer on a purchase, as long as it's a single unit, like a condo, townhouse, single family home. If you go government, which is VA, FHA, and USDA, those three options give different choices. And what they do is, we always used to kind of say conventional is the guy and the government is the girl. Conventional says, I just want to know the facts. Government says, well, tell me the story. And so with conventional, it's this. If you fit it, you fit it. If you don't, we don't want you. And it's not a personal thing, which is kind of a good thing because it makes it very straightforward. Do you have a high enough credit score? Do you have 2 years of income that we can prove? Do you have enough assets? If any of those things are off, then we have to move over to the government side.
These filters that your family or somebody that you believe knows the market and knows financial lending, if that's something that you're relying on, my concern is, are they familiar with what's current and what is available? Because that may be somebody that, yes, you trust this person, but maybe the last time they purchased was 40 years ago. And I will tell you very clearly, I've experienced where I had a client, a seller, who was not going to accept a buyer's offer on their home because they didn't see where the buyer was paying points. Steve, if you gave somebody advice right now, what's one thing they should stop doing?
Hate to say it, but it's 100%. It's the Klarna, Affirm, these payment plan things. Gotta stop those. They're just very difficult. There's just a lot of things that go on the credit with that. It's the funniest thing. So people can they can buy groceries on Affirm. And what it is it's like a payment plan. Instead of paying the groceries off with your credit card, now all of a sudden it's a 2 or 3 payment plan to pay your groceries. And so because of that, now we have a debt that's on their credit. And so it can be very messy. And so what happens is we've got to make sure we get those balances paid to zero.
When you buy a home, it isn't just the down payment. So let's talk about what is going to have to get paid.
Like you said, a lot of times people come to me and they go, oh, hey, we're going to buy this $400,000 home. It's not just the $20,000 to buy the house. And even if the seller's willing to pay all the commissions, that doesn't pay for the closing costs to be able to be done. I said, and you could go through the gamut of all the different costs, but even the major ones, you got title fees these days, which could be, I've got a $335,000 purchase going on right now that the title fees are $4,300. Wow. That's the first fee. We haven't even gone on to anything else. Just title is $4,300. Then you got lender fees, which are, anywhere from $1,000 to $2,500 typically. You got an appraisal, which is $500, $600, $700. You got homeowners insurance, which people forget about. You have to pay for 1 year homeowners insurance up front. Even if it's a condo, it still could be $1,000 a year. So that's $1,000 up front. If it's a single family home, you might be paying $3,500. Now that's $3,000 up front that you weren't thinking about. I hate to say the nickel and dimes, but there's kind of like, let's say you work for a company, we have to do a verification of employment. Your employer is going to charge something, $200, $300. If it's a condo, we have to get condo docs. That's $300, $400, $500. So by the time you turn around, we could be looking at $10,000, $12,000, $15,000 in closing costs. And the people may come to me and they have nothing. They just have the money for the down payment.
Thank you, Steve. I appreciate your spending time with me. And I know we'll have another video in the future that we'll work on. And for anybody who is watching, in the description on the video that you're watching, we will have Steve's contact information as well as mine. And there is never a question you can ask us. And also that we won't find the answer out for, because we will. We will find out the answer.